America now pays more to service its debt than to run its military. Not as a projection, as a fact. $970 billion in interest last year, $917 billion in defense. The interest won.
In the next 12 months, $9 trillion comes due for refinancing, at rates 3 times higher than when originally borrowed. Every dollar borrowed to pay the interest creates more interest. The math has no exit. By the end of this video, you will understand why this cycle breaks most businesses and why the RBI selling dollars in Mumbai right now is a direct consequence of decisions made in Washington in 2020.
You're watching Voice on Pages, where capital logic replaces capital noise. Subscribe if you think in systems.
The rate reset math is the structural mechanism driving everything we are about to look at. Right now, there is a foundational reality hitting the market. $9.3 trillion in U.S. debt matures by March 2026. That is roughly 1/3 of the total public debt, and it has to be rolled over. We aren't talking about a standard market operation anymore. This is a systemic bottleneck.
The mechanics of this rate reset are entirely unforgiving. Back during the pandemic era of 2020 and 2021, those legacy coupons were locked in at roughly 1.5%. Now, as that debt matures, it has to be refinanced at the current 10-year yield, which sits firmly around 4.6%. It is like holding a credit card where you can only afford the minimum payment. The balance never shrinks and the interest just compounds. The holder might call it managing finances, but the structure calls it a trap. Mechanically, the system is dictating a permanent penalty here, adding an undeniable $30 billion to annual interest for every single trillion refinanced. When you apply that math across the entire maturity wall, the sheer magnitude becomes impossible to ignore. On a $9 trillion rollover, up to $270 billion in extra unavoidable annual interest is mathematically locked in this year alone. There is no policy maneuver, no clever adjustment that alters this fundamental arithmetic. The condition is set entirely by the immense cost of simply maintaining the existing leverage. Looking at the global debt scale, we are facing a $348 trillion reality. If we widen the aperture beyond Washington, the macroeconomic picture carries the exact same strain. The Institute of International Finance confirmed that total global debt reached an unprecedented $348 trillion at year-end 2025. And the trajectory? It is actively heading toward $353 trillion as we move deeper into 2026. To truly grasp that scale, you have to look at what a 305% global debt to GDP ratio actually means. The world currently owes more than 3 times what it produces in any given year. This massive framework was built entirely under the illusion of near-zero rates, so it remained invisible until those rates were forced to reset. Now the burden is structurally inescapable across all global markets.
The founder of Voice on Pages, Nitin Tyagi, wrote "Stop being busy" after running his first business this way, borrowing short-term to survive, working 18-hour days to service the cycle, never questioning the structure, until the structure answered for him. Governments are doing the same. At $348 trillion.
So, who holds the bag? We have to look at the buyer of last resort. The immediate question the market faces right now is who actually absorbs this newly priced debt. Institutional mechanics dictate that when foreign demand starts waning, someone has to step in to clear that immense supply. But finding buyers for this avalanche of issuance is rapidly becoming an escalating challenge for the entire financial system. You can see this strain perfectly in the March 2026 2-year Treasury auction. The bid-to-cover ratio dropped to 2.44, which is the lowest demand we've seen since May 2024. Consequently, primary dealers, who act as the mandated buyers of last resort, taking what nobody else wants, were forced to absorb 24.1% of the issuance. That is the heaviest dealer take since October 2022. It signals serious fatigue among traditional buyers. The sovereign wall is massive, but the private sector echo is just as critical. Look at the corporate debt profile maturing in 2025 alone. We are talking about $951 billion in U.S. corporate debt and another $660 billion in commercial real estate debt. These maturities are hitting the market at the worst possible moment. The identical cheap money trap that governments are desperately trying to refinance right now sits on the balance sheet of nearly every major employer. And that vulnerability is highly localized within specific corporate structures. Fully 50% of all speculative-grade debt due by the end of 2026 is heavily concentrated in just 3 sectors: healthcare, media, and telecom. The trap lives inside the very companies people work for and invest their capital in every single day. But capital doesn't follow safety, it follows logic over loyalty, and it moves swiftly away from these vulnerable balance sheets.
This brings us to the India consequence, because they are squarely inside the blast radius. This massive U.S. refinancing demand mechanically absorbs global liquidity, acting as a powerful vacuum that strengthens the dollar against emerging market currencies. We can observe the geopolitical mechanics of this pressure directly impacting major global economies and forcing rapid policy adjustments.
The Reserve Bank of India has been forced to take highly specific, aggressive actions to manage this imported volatility. Between January and October 2025, the RBI net sold $31.98 billion in the spot market just to defend the rupee. This wasn't theoretical. It was a clear, data-confirmed intervention. Their goal was purely to stabilize their currency against the immense gravitational pull of U.S. yields.
Mapping the chronological escalation shows just how intense this defense really became. After those initial spot sales, the RBI committed $88.75 billion in forward dollar sales by February 2026. This sustained defense caused India's primary war chest, its foreign exchange reserves, to drop from $591 billion down to $563 billion. And despite these immense efforts, the sheer force of the Washington trap still pushed the rupee to a record low of 92.5 to the dollar by March 2026.
In direct response to this pressure, India initiated a major defensive portfolio shift. They systematically cut their U.S. Treasury holdings from $225.7 billion in January 2025 down to a 5-year low of $182.9 billion by December. This aggressive reduction is a calculated maneuver to mitigate their exposure to the very asset that is draining global liquidity. India is not inside the trap. India is in the blast radius.
This pressure accelerates the emerging market turn, actively redirecting capital. Beneath the surface of this primary market turbulence, a highly consequential reallocation of global capital flows is quietly occurring. As the central system strains under its own weight, investors are actively searching for alternatives, redirecting immense pools of liquidity away from traditional safe havens. Institutional repositioning is firmly underway. Major players like Morgan Stanley and Aviva are declaring emerging market debt as the definitive 2026 opportunity. And the data supports this pivot, showing $13.2 billion flowing directly into emerging market debt in late 2025 alone. The Bank for International Settlements confirmed this exact trend in March 2026, noting that investors are aggressively extending their search for yield into these emerging economies. Synthesizing these dual forces reveals a really complex dynamic for the Indian economy. On one side, the RBI is bearing the short-term cost, burning through reserves to defend the rupee against a strong dollar. But simultaneously, this exact U.S. trap is creating the very capital flows that could benefit India long-term, as foreign capital intensely searches for the robust yields offered by emerging market bonds. Evaluating the historical reality helps us understand the true burden we are dealing with. To anchor this current mathematical reality, we have to look at it against the last comparable rate reset. The Volcker era of the late 1970s and early 1980s is really the only modern precedent we have for this kind of structural interest rate shock. Examining the metrics of that period provides a forensic baseline for understanding our present conditions. Contrasting the historical data reveals a stark, undeniable truth. During the Volcker era peak from 1979 to 1982, the interest burden hit 2.5% of GDP. But crucially, total debt remained under 30% of GDP. Today, the U.S. carries a 3.15% interest burden on a massive debt base that significantly exceeds 100% of GDP. By the only true measure of structural burden, our current environment is mathematically more severe than the absolute peak of the Volcker era. The unavoidable mathematics of this environment remain entirely unresolved. We are operating within a globally synchronized reality, heading toward $353 trillion, facing an immediate $9 trillion maturity wall in the coming 12 months alone. With every trillion refinance demanding an additional $30 billion in structural penalty, the system simply compounds its own pressure. The refinancing cycle has not peaked yet. The math offers no exit. The founder of Voice on Pages has written a book called Stop Being Busy about rebuilding clarity after losing everything he built. It is on Kindle, link below.
Because in the end, capital doesn't have loyalty. It has logic.